All right, guys, here we go. We got Chevron. Chevron sitting at $182.46 a share. Over the past day, that would have been Friday. It was down 0.31%. I'm recording this on Sunday afternoon. On a 5-day chart, it is down 3.97%. On a 1-month chart, it's down 5.61%. On a 6-month chart, it's up 19.61%. Year to date, it's up 19.72%. On a 1-year chart, it's up 32.37%. On a 5-year chart, it is up 68.24%. On a maximum chart, this goes back to May 30th, 1986. Chevron is up 1,724.6%. Pretty cool. So they got a 3.9% dividend. That's $1.78 a quarter. A PE ratio of 31.67. A 52-week high of $214.71. A 52-week low of $135.21. A market cap of $363.39 billion. A EPS of $5.76 with 1.99 billion shares outstanding and about 43,000 employees. So let's look at their overview. Chevron declined recently following a first quarter revenue miss that overshadowed a significant earnings beat. While operational momentum remains strong, analysts project that the integration of Hess and structural cost-saving initiatives will be the primary drivers for the next quarter, as sentiment suggests optimism regarding record production levels in the Permian Basin. Okay. The bullish view. Substantial Q1 2026 earnings beat. Chevron reported adjusted diluted earnings per share of $1.41 for the first quarter of 2026, significantly surpassing the consensus estimate of approximately 97 cents. This outperformance was primarily driven by a higher upstream production volumes following the successful integration of Hess assets and robust growth in the Permian Basin. Aggressive shareholder return policy. The company returned approximately $6 billion to shareholders in the first quarter of 2026 through $3.5 billion in dividends and $2.5 billion in share repurchases. Management maintains a quarterly dividend of $1.78 per share and projects sustained cash flow growth to support its long-standing track record of annual increases. Strategic portfolio expansion via Hess. Completion of the Hess acquisition has granted Chevron access to the Stabroek Block in Guyana, described as one of the most significant oil discoveries in recent history. Analysts expect this asset, combined with a 7% to 10% projected production growth for 2026, to provide high-margin cash flow durability. Cool. Here is the bearish view. Revenue miss and margin pressure. Despite the earnings beat, the first quarter revenue of $48.61 billion fell short of the anticipated $51.39 billion. Additionally, adjusted downstream earnings faced pressure from unfavorable timing effects and inventory valuation shifts, while overall costs increased approximately 6.3% year over year, impacting bottom line growth compared to the previous year. Premium valuation versus industry peers. Chevron currently trades at a forward PE of approximately 20.86, representing a significant premium compared to the integrated oil industry average of roughly 10.04. This elevated valuation, coupled with recent large-scale insider selling, totaling over $233 million, has raised concerns about limited near-term upside potential. Yeah, that PE ratio seems a little high to me. But whatever, it just depends. So let's go down and let's see when the last time that they missed was. Alright. So they reported on May 1st, 2026. They got a 45.56% beat on EPS. They were predicted to get 97 cents. They got $1.41. But they missed on revenue. They got $47.81 billion. They were predicted to get $52.70 billion. That's a 9.27% miss. Not great. They miss pretty regularly on both EPS and revenue, so They beat by 45.56% on EPS in their most recent quarter. That's pretty cool, but they missed by 9.27% on revenue. So that's no bueno. Then in Q4, they also missed on revenue. They beat on EPS. Q4 2024, they missed on EPS, but beat on revenue. Q2 of 2024, they missed on both. They missed revenue by 1.87%, and they missed EPS by 14.90%. So they'd be missing pretty regularly. Chevron. We'll read the Motley Fool here. Exxon and Chevron are warning that oil prices could skyrocket in the coming weeks. Here's what that could mean for investors. This is by Matt DeLallo. Oil prices have cooled off over the past couple of weeks due to optimism that the U.S. and Iran are close to a peace deal. That would reopen the Strait of Hormuz. Brent oil, the global benchmark price, was recently around $90 a barrel, down from over $110 a barrel in midday. While Brent is still up more than 50% on the year, it had almost doubled at one point. The current respite might not last. Executives of Exxon and Chevron recently warned that oil prices could skyrocket over the next 2 months as oil stockpiles continue draining. Here's what that could mean for investors. Emptying the tanks. The Strait of Hormuz closure is causing the biggest oil supply disruption on record. While production in the Persian Gulf has plunged by more than 50%, that has forced the global economy to tap into its oil storage to bridge the gap, including national emergency stockpiles such as the U.S. Strategic Petroleum Reserve. The world is burning through a record of 8.7 million barrels per day from global stockpiles, according to an estimate by Goldman Sachs. The total supply loss since the war began exceeds 1 billion barrels. One positive is that global inventory levels were high heading into the war, giving the global economy a sizable buffer to handle the current supply shock. However, Chevron CEO Mike Wirth warned at a recent press conference that the buffers and the shock absorbers are being steadily drawn down, and the ability for the market to absorb this imbalance is drastically diminished today versus where we started. For example, U.S. commercial crude inventories ended last week at 441.7 million barrels and 2% below their 5-year average at this time of year. Meanwhile, the SPR has fallen to 365.1 million barrels, down from 415.4 million barrels before the war began, which was well below its 714 million barrel capacity. We're approaching unheard of inventory levels, warned ExxonMobil Senior Vice President Neil Chapman at the same conference. There's a little graphic. That's just the price of Exxon there. So, reaching a critical level. Global oil inventory levels are approaching the danger zone. Exxon's Neil Chapman warned that you can debate whether that's going to hit those really low levels in 2 weeks or 3 weeks. Once you get to that point, then you'll see the price shoot up. Chevron CEO Mike Wirth made a similar comment. Over the next few weeks, we're likely to see those pressures flow through more directly to physical prices, and there's more upward pressure that I would expect as we get into June and certainly into July. That doesn't sound very fun. Chapman speculated that once oil inventories reach their all-time lows, Brent could skyrocket to $150 to $160 a barrel, surpassing its all-time high. Others in the oil market have issued similar warnings. JP Morgan previously cautioned that Brent could spike above $150 if the supply through the Strait of Hormuz remained disrupted through mid-May. Meanwhile, Goldman Sachs modeled a severely adverse scenario where crude prices could top $140 a barrel if the Strait of Hormuz doesn't fully recover by the end of July, and there are issues bringing oil supplies back online across the Middle East. Rising market risk if the strait doesn't reopen soon. The global oil market is reaching a crucial point. If the Strait of Hormuz doesn't reopen soon, oil prices will skyrocket due to dwindling global inventory supplies. Those higher prices will cause demand destruction, helping align demand with supply. That would likely drive a meaningful slowdown in the global economy. On a more positive note, the U.S. and Iran are reportedly close to a deal that would, among other things, fully reopen the Strait of Hormuz within 30 days now. Getting oil flowing out of the Persian Gulf again would prevent that worst-case scenario of hitting an all-time low in global oil inventories. However, investors need to keep an eye on the oil market, as a resurgence in oil prices could trigger a global recession and a stock market downdraft in the coming months. Taking a more defensive posture and buying oil stocks like ExxonMobil and Chevron could help hedge your portfolio for some of this risk, according to the Motley Fool. Not according to your cousin Dustin. So that's pretty cool. Let's keep moving. Let's do this. Yeah, Chevron CEO. I like to look at the CEOs just to get a look at this guy, you know? Oh man, it didn't give me the pictures and stuff. There he is. Mike Wirth is the chairman of the board and chief executive officer of Chevron, a role he has held since 2018. Born in 1960, Wirth earned a bachelor's degree in chemical engineering from the University of Colorado in 1982 and began his career at Chevron in 1982 as a design engineer. Over the decades, he held multiple senior positions, including president of global supply and trading, executive vice president of downstream and chemicals, and executive vice president of midstream and development. Wirth is known for his leadership in Chevron's Permian Basin operations, which saw record production under his tenure. He serves on the boards of the American Petroleum Institute Catalyst and the National Football Foundation, and is active in industry councils such as the National Petroleum Council and the World Economic Forum's International Business Council. Cool. There he is. Get a picture of him. Alright. Okay. Looks pretty cool. Nice. Well, let's do one more thing. Well, a few more things. How has the war in Iran affected Chevron's as a business? Answer in one paragraph. We'll ask Gemini this. The war in Iran has had a highly complex, double-edged impact on Chevron's business, resulting in short-term profit friction despite soaring global crude oil prices. While surging commodity prices are projected to boost Chevron's long-term upstream earnings, the effective closure of the crucial Strait of Hormuz shipping corridor caused severe operational dislocations, stranding oil inventory in the Persian Gulf and knocking out roughly 6% of the company's global production in the first quarter of 2026. Furthermore, the rapid spike in oil and natural gas prices triggered steep market-to-market derivative hedging losses of up to $3.7 billion, causing Chevron's first quarter adjusted profits to drop significantly to $1.41 a share from $218 a year prior. However, because Chevron maintains the lowest direct asset exposure to the Middle East among the oil supermajors, it remains structurally well-positioned to leverage its robust domestic production in the Permian Basin and expanded projects in Venezuela to capture a lucrative geopolitical risk premium over the long term once supply chain timing mismatches iron out. To hear Chevron's executive perspective on navigating this volatile energy environment, you can watch the Chevron CEO interview on Face the Nation, which provides first-hand commentary and Mike Wirth regarding the unpredictability of the conflict's lasting impact on global markets. No, we're good. We're good. So let's compare their stats to ExxonMobil. Just a side-by-side. Okay, so Exxon has a 2.84% dividend. That's $1.03 a year, or a quarter, my bad. Chevron has a 3.9% dividend. That's $1.78 a quarter. All right. Exxon has a PE ratio of 24.51 and an EPS of $5.93. While Chevron has 31.67 PE ratio and an EPS of $5.76. So they have a little lower PE ratio, a little higher EPS. Does Exxon there. But Chevron has a slightly higher dividend. Chevron has a $363.39 billion market cap, while Exxon has a $602.09 billion market cap, so almost twice as big. Or actually more than, almost twice as big. Fascinating. Now, I want to do this. So there's our price on the chart there. I want to compare it to crude oil. So you can see they kind of move with each other. That's why I wanted to do this comparison here. To an extent. Over the past 6 months, or year to date, on a 1-year chart, crude oil's up 43.89% and Chevron's up 32.37%. So, on a 5-year chart, crude oil is up 29.2% and Chevron is up 68.24%. So maybe there's not such a correlation. But I just thought that would be interesting to look at. So there you have it. Chevron. I know they said that they're not going to pay any of the tolls. I think that's kind of interesting. We'll see what comes of that. We'll see if Iran makes them pay, or if they decide if they can figure it out. Like and subscribe, guys. It's your cousin Dustin. Like and subscribe. Help me out. Good times. Thanks.